Equity Mates, from our mates at Spaceship. Investing made easy.
Welcome to another episode of Equity Mates. My name is Bryce and it is that time of week, Watchlist Wednesday, and as always I am joined by my equity buddy Ren. How are you going?
I'm very good, Bryce. Our favourite episode of the week, we are joined by an expert and we're going to sit back, relax and hear about 3 stocks on their watch list.
Yes, so it is our absolute pleasure to welcome to Equity Mates for the first time Marcus Bogdan. Marcus, welcome.
Thank you very much for having me.
So Marcus is the Chief Investment Officer at Blackmore Capital. They're an ASX 200 focused fund manager based down in Melbourne, and we're very excited to have him as part of the Equity Mates family now for the very first time, and he's bought 3 stocks that are on his watch list or in the fund, which we're going to crack into today. So Marcus, let's start with the first one, Amcor. The ticker is AMC, $18 billion market cap. Are you able to tell us firstly what Amcor does and why it's on your watch list?
Yeah, Amcor are one of the doyens of the Australian market. They've been around a long time. They're essentially an international packaging group, and the business is split in both the flexible packaging, which you'll see in supermarkets, principally around food. And then there's a rigids division as well, which is really things like drinks. They have only got around about 3% of their sales in Australia. They're primarily a Northern Hemisphere company. Largest market being the United States, around 47% of their revenue, and then Europe, 24%. But they've also got a very big emerging market presence, and that's over 20% also. So been listed for a number of years. They've had an impressive history in the last 10 or so years, and they've been very good at making quite significant and structurally important acquisitions.
So Marcus, it feels like the packaging game would be a commodity business. So I'm interested to know, well, 1, is that assumption right? But 2, who are some of Amcor's major competitors and why is Amcor better than them?
Yeah, so you're absolutely right. There are large tracts of the packaging industry, which is obviously commodity sensitive and commodity facing. I think where Amcor has positioned themselves is in the higher margin areas where branding and packaging is incredibly important, and that's where they've been able to develop themselves in the fast-moving consumer goods cycle, and so they face up to very large global corporate competitors in each of their markets, both international and local markets. They've historically been in canning and in wine bottles, but they spun that business off. That was called Aurora. And one of the drivers and one of the reasons that we actually like them from an ESG perspective is the move that they have gone through into sustainable packaging. This is something which is incredibly topical, but being able to deliver that for companies such as Nestle and the really big consumer groups is particularly important now. And so that's a key advantage for them. Importantly, around commodity prices, you would have seen a number of examples where commodity prices have been rising very, very sharply. And that has affected Amcor's markets, particularly in resins and in aluminium. But they have been able to navigate through that. Their contracts are pass through in terms of their pricing. So they do have an element of pricing power, and they are positioned in those higher end markets. And more recently, they acquired a company called Bemis, and that moved them into the sort of the healthcare packaging as well. And again, those types of areas have high barriers of margins and a high level of sophistication in their packaging. So we do like them because they are facing into high-end consumer markets with quite high barriers to entry.
Yeah, interesting. So that's Amcor, $18 billion market cap, ticker AMC. Marcus, the next one on your list is CSL. No doubt, I'm sure almost all investors watching at the moment know who CSL are. Australian homegrown hero, biotech company, $126 billion market cap. Why is CSL on your watch list?
So two of the stocks I've chosen tonight have absolutely lagged the market over the last 12 months. And CSL is definitely one of them. And Amcor was also a company that has not kept up with the overall market. But the underperformance of CSL against the rest of the market has been incredibly pronounced. And that's why we're particularly interested in that company at the moment, given the high quality of their business. And the reason why they've underperformed is their largest business is plasma therapies. That is, again, Northern Hemisphere facing. Their largest market is in the United States. And whilst the demand for plasma has continued to be very strong, and we think the long-term growth rates are around 8 to 10% per annum, they have been affected by COVID because they get the plasma from patients donating blood and plasma, and people just have not been able to get to centres. There's been social distancing there, and volumes for the overall industry are down 20%. And so that perception and that impact has affected CSL's share price, and that's where we see the opportunity. That's the largest division. The second area is a business which has actually been a beneficiary of COVID, and that's been the vaccine business, principally in flu. And so last year's Northern Hemisphere winter, Southern Hemisphere winter, have been sellouts for flu, given that is a respiratory infection like COVID. So demand for there has been particularly strong. And even if you look forward to the next Northern Hemisphere summer in December of 2022, there's also been record demand for that business. So we expect that the vaccine business will continue to grow incredibly strongly, but as COVID vaccines start to be rolled out very effectively in the United States, we have started to see a pickup in plasma collections, and we expect that will normalise by the end of this year. And CSL is well positioned to deliver double-digit earnings per share growth in FY23, and I think then that will be recognised by the market, and then you'll see a re-rating of their shares.
So, Marcus, CSL for us is just, it's a fascinating company, and it's one that, you know, no analyst ever seems to have a bad word to say about the actual business. It really only ever comes down to valuation, and
yes.
CSL in some way feels a little bit like Amazon. You know, it's always too expensive, but it's always growing. How do you think about when the right time to enter CSL is, or any of these companies that seem to be perennially overvalued but just keep performing?
Well, I think you still have to be aware of the valuation, and we actually reduced weighting in CSL when they were around $330 because we felt at around 40 times at that price that was fully embedded in the price. And we do want a margin of safety. So the price has come back to around the sort of the 270s, and we believe that a price earnings ratio of around 32 times in FY23. Given that we expect that you'll get a very sharp recovery in earnings per share growth, does give you a margin of safety. And you're right, it is an absolute darling. They have executed for the entire period of my career. They've been industrially focused. They've got an absolutely leading global footprint in both plasma and vaccines. And the vaccines business is one which they've really built up in the last couple of years, and they've been able to really drive that as a new area of growth for the company. So it is the recent price weakness that we believe that gives you some valuation support, and that's why we've recently added to the stock. It's only been in the last 3 years that given significant restructuring in the company, that we felt that there was sufficient catalyst there and sufficient value in that company. So Healius, 80% of the business is in pathology. So they're one of the 3 leading pathology companies in Australia. And ironically, they have done incredibly well through COVID, through the PCR testing. And that's been an absolute driver of both revenue and earnings for all of the pathology companies. And we expect that trend will continue for the foreseeable future. Lots of testing every day, and when there's been incidents of COVID in the community, you've seen a step up in testing. Each of the pathology providers gets it's $100 per test, and the government have actually extended that regime from the end of December through to June 2022. So that's a real fillip for Healius, and we expect that will continue, particularly through winter, particularly where in childcare, in schools and work, people require a COVID test if they've been sick to show that they've got a negative test. And we believe that COVID will be seasonal going forward. The second area that they're involved in, which is just under 20% of the business, is in imaging, radiology. Again, they're one of Australia's leading companies there. And the third area is in short stay hospitals or day hospitals. And we do believe that is an absolute area of growth where there has been a focus on same-day surgery and same-day procedures, and they've been able to grow that business in the last year by around 25%. The balance sheet now has been de-geared through the sale of their primary healthcare business, the GP practice business. So net debt to EBITDA is under 1 times. It's allowed them to provide to reinstate the dividend, and the balance sheet is in absolute pristine condition, and that's allowed them to have a buyback as well. So overall, healthcare, we're overweight healthcare, and we certainly believe in pathology and daycare hospitals in particular, that there are really strong themes there going forward, and the valuation is undemanding.
So Marcus, that does bring us to the end of our time. I've just got to make a note of Healius's name though. I think whichever marketing executive came up with that is pretty funny. Going from primary healthcare, pretty true to label, to Healius, which has got like bit of health, bit of tech vibes to it. I don't know about some of these names. But look, anyway, we want to thank you for joining us today. We appreciate it. The 3 stocks, Amcor, CSL and Healius. Everyone should be looking at them, adding them to their watch list. So Marcus, thanks for joining us today.
It's a pleasure. Thank you.
Well, that brings us to the end of Watchlist Wednesday. If there is any better example than putting a stock on your watch list
for 15
for
years.
15 years, that is a true definition of a watch list. But we are going to be back tomorrow to close out the week here at AusBiz with a big app
A big ep.
Yes.
In case you missed it, Bryce did turn 30 last week. We had to do a week of AusBiz on it. We had to do a podcast episode on it. He wants you to know he turned 30. But look, as part of the celebration, we went to a bunch of experts and asked, in celebration of Bryce's 30th birthday, what stock would you hold for the next 30 years? So we've got 5 experts that answered that question. We're going to be talking about the stocks they chose tomorrow. We might also answer that question.
Yes, we will.
Yes. So join us tomorrow as we answer the big question. What stock would you hold for the next 30 years?
Huge. We'll see you then.
Equity Mates, from our mates at Spaceship. Investing made easy.